we are going to shock the economy in the context of our model. Recessions can come from lots of different places. Let's do all of them. First up, a spending shock. Anything that affects consumption, investment, government expenditures, net exports is going to move that IS curve, either positive or negative. So let's say consumption drops. That will move our investment savings curve to the left, which means we will have a more negative output gap. This can cause a recession. In fact, we got a bunch of different things that can influence consumption. What causes consumption to go up? Well, if we're more wealthy. Wealth is not the same thing as income. We can get a boom in the stock market. We can get a boom in the housing market. Anything that increases wealth means people will feel more comfortable and they will consume more. You can have an increase in consumer confidence. If consumers are feeling better, they'll go out and spend more. Likewise, you can have direct government assistance. Creating Social Security back in the 1930s helped prevent poverty among the elderly. Additionally, the expansion of Medicaid and Medicare all created a world where today the elderly are considered consistent consumers and the rates of poverty among the elderly have plummeted. On the other hand, you can lower taxes. With lower taxes, you have higher income. With higher income, you have higher consumption. And then that last bullet point is about inequality. Who spends a higher percentage of their income? The more wealthy or the lower income? The lower incomes do. So as we lower inequality or we redistribute money from those who don't spend to those who do spend, we will see a higher increase in the total consumption of the economy. Next is investment. What forces out there cause an increase in investment? Well, a general economic expansion. If the economy is growing, businesses are feeling great and they're going to start investing in stuff, in long-term projects. Same with consumer confidence. Higher business confidence means higher investment. Lowering corporate taxes means higher revenues, more profitability, more investment. Easier lending standards means it's easier to get a loan, so firms invest more. And the last one is uncertainty. When there is less uncertainty, businesses have more confidence that their investment projects will pay off. We will see more investment. With more investment means a rightward shift in the IS curve, which will result in more economic activity overall. Notice when we shift the IS curve and only shift the IS curve, it doesn't do anything to the interest rate. Why? Spending shocks don't affect the interest rate. They only affect real GDP. Remember, the interest rate is simply determined by two things. The Fed directly with their risk-free interest rate, and then the private economy determining what their risk premium is. Now, more than one of these things can happen at the same time, but remember, when we're building a model, we want to know how each individual shock affects the whole economy. Then, when we want to take it to the real world, we can add up all the shocks, plug it in the model, and see what happens. So as of now, when there is less uncertainty, they will demand more loans at the prevailing interest rate, which will increase spending, shifting that IS curve to the right, increasing real GDP. Next, what causes government expenditures to go up? The political process. It can be a direct spending bill, such as very explicit stimulus bills during a recession, or it can be an automatic stabilizer. And automatic stabilizers kick in regardless of passing a new bill. Unemployment insurance is often like this. A whole bunch of people become unemployed and automatically they receive that funding. Now, this isn't G in the C plus I plus G plus NX because unemployment insurance is just a transfer. Transfers are not included in direct government expenditures. Government expenditures are direct purchases of goods and services, but unemployment insurance feeds into households, which in turn increase consumption, spending, etc. A lot of the social safety net is an automatic stabilizer. If you lose your job, then you become qualified for SNAP benefits. If your income is lowered, you'll have a smaller income tax burden. We like to have automatic stabilizers because we don't always know when a recession begins, and it takes an act of Congress to get a spending bill through, which sometimes can happen very quickly, and other times can be bogged down in political partisanship. But the macroeconomy doesn't care about your partisanship. If we want a functioning economy, which we economists do, automatic stabilizers are for the win. Finally, net exports. They do up if the total global economy is doing well. If the value of the US dollar falls, this makes US exports cheaper on the global market. Other countries will buy more. And we can also change trade barriers. If other countries lower tariffs against our goods, they'll start buying our goods more. Likewise, because this is net exports, not just regular exports, if you make imports more difficult, net exports will go up. However, because most tariffs are two-sided, we want to have good relationships with our trade partners. If we're all experiencing a recession, we want to maximize total global economic activity. Very famously, the Smoot-Hawley Act in the 1930s increased tariffs to help boost the domestic economy, and the evidence points to the Great Depression becoming worse because of it. Now, we can also have financial shocks. That's the cool thing about this model. It's going to give us that link between the financial market and the real market, the real economy, the real spending, the real jobs. Remember that risk premium? What if it got bigger? What if everybody started getting spooked? That means all of the interest rates in the economy are going up. That means we gotta move the MP curve. We have to shift it up. The interest rate in the economy is now bigger than it was, which means we intersect over here. With a higher interest rate, what happens to spending? Less consumption spending, less investment, less net exports. What happens in the financial sector can influence the overall economy. That's the point of this little model. Our little ISMP model here says real interest rates affect real spending, and real spending affects real gross domestic production. So this matters. Now the Fed can come in and help fix this. They can lower that risk-free interest rate down to 0. Delete. Move that wording. And then I can lower the MP curve. So we'll show that in pink. We're down to another interest rate. And that again can help boost the economy. Boop. That's one reason we have an active Federal Reserve, and that's one reason the Federal Reserve is so involved in the financial sector. They want to make sure the financial sector is running well and that we don't have negative risk premium interest rate shocks. Well, how does the Fed directly affect interest rates? We discussed that they directly control the federal funds rate. That can change the risk-free rate, but how can they influence the risk premium? Number one, they can act as a lender of last resort. They go into the financial sector and they say, hey, everyone calm down. You all have decent collateral. I'll give you a short-term loan to make sure you got enough cash to meet any obligations you have in the moment. Everyone can stop calling in their loans. You're going to be paid back eventually. The other thing they can do is communicate simply with their words expectations about the future. Not only can they lower the risk-free interest rate today, but they can promise that the risk-free interest rate is going to stay low for a long time. Remember, part of that risk premium is composed of length, and if you know interest rates are going to be low in the future, that means some of the risk premium today will be a little lower for long-term interest rates. And that's your basic model for recessions. Recessions can be caused through the financial sector by shifting the MP curve. We've learned we basically have two ways to solve it: monetary policy to influence interest rates, and fiscal policy to help influence spending. And during a recession, we use both of these methods. And a very severe recession, like we saw in 2020 and 2009, we'll use these methods drastically. We also saw that very large fiscal stimulus spending had powerful results in making the severe COVID recession very short and the recovery very fast, all while mitigating economic hardship and suffering along the way.